Hey everybody, this is the Emini review for Tuesday, June 25th, 2024. And we'll start with the daily chart. I think I mentioned at the end of the last video, coming into the day, we're expecting support in this area because if you look to the left, I'll zoom in a little. We have this bull breakout on June 17th. And so the bar before the breakout bar is actually not a good buy signal bar. It's a trading range bar. It's a high one after maybe a parabolic wedge, maybe 2 or 3 legs up. So there's bears who sold above this bar and they got trapped. So then we had this bull breakout. Bears who sold, they're scaling in higher. What are they going to do on a retest? Well, the market's coming back to retest. The expectation, at a minimum, is a bounce. So I thought there was support in this area coming into the day, and that was around the low of yesterday. Yesterday was an outside down day. Outside bars or trading range bars. So the odds were there were buyers below the low of yesterday and sellers above. But because it's a trading range bar, we had an inside bar, an outside bar. The odds are the market's going more sideways, so we can expect more trading range price action for today. We had this fairly big sell-off at the end of yesterday, but pretty interesting and important to note that it could simply be a sell vacuum and 3 legs down. And so we might be at the bottom of a trading range here. And then this red line down here is the high of that doji signal bar that I pointed out. The high of this bar right here. So we're expecting support at that red line. Today we gapped up on the open and bar 1 was a bear trend bar. We opened above the 5-minute moving average and bar 1 crossed it and closed below it. So that's good for the bears. But like I just mentioned, if you look to the left and you look at the context, market is more likely in a trading range. And if it's in a trading range, the high of the range could be all the way up here. Maybe it's here. Maybe it's here. But we know that the low is probably somewhere around here, maybe a little lower, below yesterday's low, which I'll draw. Strong enough bar. It's probably going at least a little bit lower, and there's more sellers above the bar. But as far as selling here, you're probably selling low in a trading range. Plus, we just had this big gap up, and I like to show this from time to time because it helps me visualize the gap. You can see it as simply a breakout. They operate the same as a breakout. So if you can imagine the gap up as a bull bar, and you think about what I just said on the daily chart, whenever there's a breakout, you look back, where's the breakout point? Where are their trapped traders? If a bear sold anywhere down here, they're trapped on the gap up. So bar 1 is a bear bar, but there's probably support below. So if we get down to here, maybe the bar 80 high or the close of yesterday, we're expecting support here and a second leg up after the gap up. So you can see the gap as a first leg. Bar 2, we went a little bit lower. Minimum follow through for the bears. It's a doji, but it closed above its midpoint, so it could be better. And we might pull back. Most breakouts pull back. Bar 1 is a breakout bar. But because of where we are, maybe traders want to sell a 50% pullback of the bar, maybe even deeper. But this is strong enough for a second leg down. But we know it's minor. We know the market's mostly sideways in the trading range. And we have this breakout point below, which I will draw. As far as bar 2, there's probably more buyers below the bar and sellers above. It's a high one, but the context is bad. It's 2 bear bars in the middle of a trading range. Bar 3, we're going sideways. We broke out above bar 2, but closed maybe around the midpoint, maybe just below the midpoint of the bar. So not a very strong bull bar, and it's completely overlapping bars 1 and 2. And like I said, we're in the middle of a tight trading range. So probably sellers above bar 3. But as far as selling below bar 3, I said this is strong enough for a second leg down. The problem is the second leg could start up here at the deepest part of the pullback. So here's leg 1, we pulled back, and maybe this tail is already the start of leg 2. If we go below bar 3, there's probably buyers below. But the problem with buying directly below bar 3 is what I pointed out here. Breakout points. We gapped up. You had bulls who missed the gap, the breakout. They function as a breakout. So we gapped up. Bulls are trapped out of the trade, and bears are trapped into a losing trade. So there's support below the market. So why would a bull buy here when they know they can probably buy lower? But 3 is a bad sell signal bar, and it's a low 1 at the bottom of the trading range after 3 sell climaxes, which was a major pattern. Sideways on bar 4, inside bar, so contracting range, the market is going more sideways. Probably sellers above the bar and buyers below. But expecting a second leg down after bars 1 and 2. If we do get a bull breakout, probably fail and pull back fairly quickly. And that goes for the bear breakout as well, because inside bars have low probability of breaking out. Their trading range is on smaller time frames, or rather their triangles on smaller time frames. And it would look something like that. And so it is breakout mode. But the apex of triangles are always magnets, so even when we do break out of triangles, the market likes to come back and test the area of agreement, the middle of the range. Outside down on bar 5, so we got the bull breakout, which failed. Now we're getting the bear breakout. Bar 5, possibly a second leg down. 1, pullback 2. Closing near its low, we might go a little lower, and I mentioned this breakout point, so bulls might wait until we get here to start buying, and maybe we get a symmetrical second leg for the bears. And you can see that would take us fairly close to that support line that I drew. The problem with outside bars is that they are also trading range bars. So we're getting a trading range bar within a trading range. So probably buyers below, but again, they may not come in until the high of bar 80. 6, we're going a little lower, but now we have a fairly clear 2 legs down to bar 2, pulled back, and then down to bar 6. 80% of days open with the trading range on the open. So this is either a bear trend from the open or a trading range. And you can tell fairly clearly by looking at this, it looks more like a leg in a trading range, especially with the context to the left. You can see where bar 6 tested and bounced. There were buyers into the close after testing the high of bar 81, the breakout point. What bulls are hoping for is the gap up was a breakout. We got a 2-legged pullback. They buy at support, and we get a second leg up. The bears were hoping we would crash straight through it, but bar 6 hesitated, and that's a problem for them. 6 is a weak buy signal bar, so you'll have less bulls buying above bar 6, but the context is okay because it's low in a trading range, 2 legs down after a bull breakout, testing a breakout point. A little bit of a surprise on bar 7, but the context made sense for it. Bar 7 is often a report bar, so there may have been some news event or report, but it's really not important to keep track of what's going on with the news. Just know that bar 7 is known to be a more volatile or range expansion bar. So bar 7 looking like a second leg up. Bull breakout, the gap up, 2-legged pullback, second leg. But if you look at bar 7, it is a good looking bull bar. Small tails, big body, crossing the moving average, but the context is not very good. This is a trading range on the open, and we're getting high in the range. We know there's probably sellers above bar 1, sellers up here. The upside's probably limited. 7, strong enough for its own second leg. But as far as buying up here, maybe buying the close of 7, it's really not ideal. And then on bar 8, it's a pause bar and disappointing for the bulls. Disappointment is the hallmark of trading ranges. So it's common to see breakout bars with bad follow through. We had that on bar 1 and then bar 2. Bar 8, there's probably sellers above, but probably buyers below. Bulls might buy a 50% pullback of the bar and look for a second leg. But they know that this is probably high in the trading range, so the upside is probably limited. There's sellers above. 9, going higher. We're breaking out above the high of the day, bar 1. And the high is 28 and a quarter. The close here is 28 and a quarter. So it closed at the high of bar 1. Would have been better if it closed above, but even if it did close above by 1 tick, it's not very major. You look to the left, we're still in the middle of this trading range, actually fairly high in the range. I also like to draw the thirds of the range. So if this is the trading range, here's the middle third where most of the trading is taking place. We're getting into the upper third, and that's where traders will start to look to sell. Bulls will take profits, and bears will initiate shorts. So both bulls and bears are selling up here. It's a simple leg, technically a micro channel since bar 6. Every low has been above the low of the prior bar. But different computers and algorithms count legs in different ways, especially in trading ranges. So we could have leg 1, pause, leg 2, and then the gap up, leg 1, pull back, leg 2. And then we're expecting sellers above bar 1. 10, a bear bar, but a weak close, but disappointing for the bulls. It's a high 1 buy signal bar at the top of a trading range with a bear body. If we get above bar 10, there's probably sellers above. What about selling below bar 10? It might be a trading range here since bar 8. So selling below bar 10 would be selling low in a trading range. We also might have support at the 50% pullback of bar 7, the breakout point, the high of bar 6. So if you're selling, the downside's limited. It's probably better to sell the close of bar 10 if you are selling. But bears will argue double top, nested 2 legs up. $11, it's an inside bar, so it reduces the probability for breakouts, probably sellers above and buyers below. The bull's hoping we get at least a second leg, maybe leg 1, pull back, leg 2 up here to test these highs. There are still traders trapped. Bulls bought up here, they got trapped. This is a resistance area, a sell zone, if we get up there. But as far as buying above bar 11, it's not ideal. We just had a breakout attempt of the bar 1 high, and it failed. The bulls might get a second attempt, but bar 11 being an inside bar reduces the probability. And if you just look at the bars on the chart from bars, even just today, bar 1 to bar 11, you can see the market is sideways. So traders are buying low and selling high. 12 triggered the buy above 11. It's another bull bar, but still within the range of bar 10. Still not breaking out of anything major. It only broke out above bar 11, and it could not close above the high of the bar. That's a problem for the bulls. Tight trading range since bar 8. Lots of sideways price action, probably sellers above. You can buy below, but if this is a trading range, this might be the high. The low might be down here. So as far as buying here, probably not ideal. Outside bar on bar 13, expanding triangle on a lower time frame chart. It's clear the market's sideways, and then you get an outside bar in a trading range. It's basically a trading range within a trading range. You know the market's sideways, it's breakout mode. Traders are buying low, selling high, and scalping. This is a tight trading range. Traders are trading with limit order markets, so not ideal to take any stop order trades so far. The bulls now have 2 failed breakout attempts of the bar 1 high. We tried on bar 9, and we tried on bar 13. Both of them failed. Whenever the market tries to do something twice, it'll often reverse and try to do the opposite. So we might come back down here, test the breakout point, the high of bar 6, maybe the low of the day, the current low of the day, maybe the close of 81, the low of the prior day. But right now the bulls are failing. Inside bar on 14, so another low probability stop order trade, buying above, not ideal. As far as buying below the bar in general with inside bars, you can do that, but it's like I mentioned with bar 12, it's not an ideal place to be buying because we might be high in a range and the bulls might be getting exhausted. Maybe it's a wedge. Up on the gap up, pull back, second leg, pull back, third leg. Bulls failing to break out. The selling pressure isn't great, but the bulls are also looking like they're giving up. There's not strong buying pressure up here. So probably sellers above 14 and buyers below, but they'll be quick to exit. 15, another inside bar. So a couple of inside bars, just breakout mode. The market's very sideways and two-sided. This is a very tight trading range. So in general, traders are trading with limit orders, buying below bars, selling above bars. But it's like I said, might be a wedge. The bulls have 2 failed breakout attempts. We might be high in the range and we might have to probe lower. And the first target is probably the breakout point. We know the market's in a trading range, and if there's a breakout, if there's a gap, which is from the high of bar 6 to the low of bar 8, I'll make it more clear. I know when I started, I struggled to see gaps. So here's a gap. From what I just said, the high of bar 6 to the low of bar 8, there's a space between those two bars. There's no overlap. And in general, it's a sign of strength, or at least momentum. Bar 7 was big enough to create that gap. It started down here, went all the way up here. So traders who sold above 6, they got trapped. But trading ranges are forgiving. So if you sold above 6 and scaled in higher, and you're seeing what the market's doing. Since yesterday and into today, the market's in a trading range. So likely that the bears can scale in or sell higher. And the gap will probably get tested, the high of bar 6. And that's typical for trading ranges. In trends, it's the opposite. Gaps stay open. It's a sign of strength. Trap traders never get a chance to exit their losing positions, and that provides fuel for the trend to continue. But for now, the reason I'm saying all that and bring that up is because we have an inside-inside pattern on 15, and inside bars typically have buyers below and sellers above. But in this context, it's actually okay to sell below. But if you are selling below it, it's a low probability trade. You're selling below a bar in the middle or in a tight trading range where every time traders sold below a bar, bar 9, 12, they're losing money. Stop orders are getting chewed up. So that's a risk you face. But I would not buy below it. 16, it's an interesting bar on 16 because if a trader did buy below 15, which is a reasonable thing to do, it's a tight trading range, limit order market, buyers below. If you bought, you're fairly disappointed with bar 16. And so for the bears, it's not like it's a dream entry bar if you sold below 15 and got 16, but it's not enough reason to exit because you have to think about the opposite side. We still have 2 failed breakout attempts by the bulls, and now 16 is a high 1 setup with a weak signal bar and with a lack of buying pressure. Just look to the left. Where are the strong bull bars? Since bar 9, 9's a decent bar, but again, context, not very good. So lots of sideways. So it's probably more sellers above 16. And so for that reason, if bears did sell below 15, they'll stay in during 16. And if a bull bought below 15, they might be quick to exit after seeing the way their entry bar panned out. And that's what happened on 17. Bulls, it's not very obvious, but it's a trap. They got trapped buying below 15. When you're buying below a bar, let me see if there's an example. Sort of like if you're buying below bar 28 yesterday, look at the bull entry bar. It's a reversal bar closing on its high. That's the entry bar you want. And ideally, it's even better than that. But the reality for the bulls is 16 was a weak entry bar, and that's why 17 became a give-up bar. We have a micro channel since bar 14, or 13, the outside bar. So every high has been at or below the prior high. Let me fact check that. 28.50, 28.50, 26 and a quarter, 26 and a quarter. So we have trending highs, and you're looking for trending anything, open, high, low, close of bars, but we're getting the minimum. The highs of bars are trending, and it's a micro channel, and that increases the chances that the first pullback will lead to sellers above and a second leg down. You can see where the market's heading to. Let me redraw that gap. I think at a minimum we'll test here. 18, you can see we tested. It's not quite drawn on there. You can see we tested the high of the bar, it looks like to the tick, 21.5. 21.5. So bar 18 tested the high of bar 6, the breakout point, and we bounced. And that's the expectation when we get back there, because logically, you think about it. Bears sell above 6, and they get trapped on 7. They scale in higher, and they're looking to avoid a loss, maybe get out at their original entry. And that's exactly where bar 18 tested. And it bounced. We tested it and reversed up, and the bar closed a reversal bar. The problem is that it's still a micro channel. It's not the strongest micro channel in the world, but it is enough bars. We have 6 bars trending with trending highs, and it's enough that the first reversal attempt is likely to be minor. Does that mean you sell above bar 18? I would not. And the reason I would not, there's a couple of reasons why. We have this bull breakout on 7, and we're expecting a second leg up. And was bar 9 the second leg? I don't know. Technically, it could even just be all one leg. And maybe what's happening is we have a bull breakout, we go sideways and pull back, test the breakout point, and then get a second leg. It's common to see that. So that's the danger with selling above bar 18. Bears do have that argument that it's a micro channel, and bar 18 is a doji, not a very strong buy signal bar, so it's a trading range bar, and we know that there's sellers above trading ranges. So there's an argument to be made, but there's an increased risk that you get trapped on an upside breakout here. $19 broke above 18, but it looks like it closed at the high of the bar. And so that could be stronger for the bulls. The bulls could not close above the high of 18, and even if they could, it's still that micro channel. So probably sellers above for at least a minor second leg down. But again, a little bit risky taking that trade because of the fact that bears were just trapped and we got a breakout test to the tick of the bar 6 high. So there's an increased risk. We get the bull breakout here. And then you get consecutive bull bars 18 and 19. 19 becomes a low one sell signal bar, and there's probably buyers below that bar. You're at a support zone, the bar 6 high, and the gap is still technically open. Even though it got tested, the bodies do not overlap. And by the bodies, I mean the open of bar 6 and the close of the last bear bar, 17. And the reason we look at bodies is because that's what the line chart plots. The line chart plots the closes of bars. And so the line chart, there's still a gap between these prices. Probably buyers below bar 19. And again, there might be sellers above for a small second leg, but it's minor. 20, we went above and found sellers above. It's really minor on this chart, but I like to point it out. If you look at a smaller time frame, it's more clear. We rallied on bar 18, pulled back, rallied on 19, pulled back, rallied on 20. That's 3 pushes up. And on some smaller time frame, this was a bear channel, then a wedge bear flag. You're expecting sellers above and a continuation. But this was enough of a trend line break, so I'll draw that as well. Here's a bear channel, and here's the trend line. It's 19, 20, broke the trend line. So whenever you get a trend line break, you expect a test of the trend's extreme. At a minimum, you're expecting a test of the low close in the bear case, which is the 17 close. Here we got the test. And with the context that I've been explaining, the breakout point, the bar 6 high, the fact that this is a low 1 in a trading range at support, there's probably buyers below. And it's really interesting. I actually might pull it up. It's a variation. It's basically a major trend reversal on a lower time frame chart. And maybe if we look at the 30-second chart really quick, just for fun. And where are we at this point? 11:10 Eastern Time. I don't recommend trading these extremely small time frame charts like the 30-second chart. Even the 1-minute chart is too fast. But I do recommend you pull up these charts and compare them to the 5-minute chart, the 15-minute, compare different time frames. Not sure if we're going to get it. We might have to do with, let me see if I can get the 100-second chart. Nope, TradeStation's not cooperating. So we'll do the 1 minute. It should be good enough. I recommend comparing different time frames, but not trading these extremely low time frame charts, just to get a better understanding of what's happening. And then you start to recognize what I'm saying. You see these patterns without having to look at the lower time frames. So here is where we're at, up to 11:10, just about here. And what I was drawing on the 5-minute, it's kind of hard to see, but more clear here. Here's a bear channel, so we have a bear trend. Trend line break, the bulls break the trend line by a good amount. We expect a retest of the trend's low, and in this case we got a higher low, major trend reversal. And then over here, somewhere over here, was that breakout point, the gap that was open, that got tested. Bar 6 on the 5-minute chart, you can see that's where we tested here. It's really interesting, and we'll get back to it. And that's what I was just showing right here. Here's that bear trend, the trend line break, the retest. So that's why we're expecting buyers below bar 20. And that's what happened on 21. We did not get below bar 20, but you can see 21, it's a surprise bar. But I like to think about these types of surprises as it's kind of like you're watching a horror movie and there's a jump scare, but it's predictable. You know, it's kind of like that was supposed to happen. So this type of surprise, it's not the low probability event, it's actually what traders were expecting. 21 big bull bar, big enough to expect more to the upside, but the danger in buying 21 is that it might be a late leg. Leg 1, pullback. Leg 2. I have this drawn. Maybe we have a wedge. I gotta turn off snap mode. Maybe we go a little higher and test this line, but this line is resistance, so the upside might be limited, and it's expected to be limited because this is either a trading range or a bull channel. And if it's a bull channel, let me clean up the chart a little bit, it's distracting. If it is a bull channel, how do bull channels operate? How do traders trade them? Traders buy below bars and take profits above bars, or you can also say swing points. So bulls, if we do get above bar 13, they're going to look to take profits here. That's where this would be 3 legs up, 3 pushes up, a type of wedge. So what do you do on bar 21? Do you sell the close? Do you buy the close? It's really sort of an in-between bar where you don't want to do either because there's probably more room to the upside, so not ideal to sell the close. But if you're buying the close, you're buying high in a trading range and possibly a late leg. So probably better to wait here. 22 going a little higher, which we were expecting, but then look what happened when we broke out above 13 and the channel line. We also got what we were expecting, which is sellers above. Strong enough up for a second leg, but an increased risk that we don't get a second leg, or that the second leg is really minor, or that the pullback is really deep because it might be a third leg up. We have the gap up, leg 1, up to bar 9 or 13. That's the second push. Here's the third push. So what about selling below 22? It's a wedge, right? The problem is that it's mostly sideways, and the selling pressure isn't all that strong. Look in here. Look at the bear bars. Bar 1's a decent bar. Bar 5, a decent bear bar. That's about it for decent bear bars. So any pullback or reversal here will probably be minor. Plus, you'd be selling after bar 21 and 22, consecutive bull bars, one being big and at least one closing on its high. And I say all that as if to say it's always in long. And it's funny because when you get that type of price action, the consecutive bull bars, one being big, closing on their high, it's easy to automatically think the market's always in long, buy for any reason. But the reality is that's the exact opposite of what you should be doing here. And that makes perfect sense because I say that all the time. When you're in a trading range, always in is like opposite day. It's backwards. So as soon as it's always in long, it's time to look to sell. Bear bar 23, disappointing for the bulls. As I said earlier, disappointment is the hallmark of trading ranges. High 1 signal bar above 23, sellers above. When you're buying high 1s, first of all, you want the bar to be a bull bar. And you also want the context to not be a broad bull channel or trading range, which it is here. You want it to be early in the spike phase of a trend when the momentum is high and the context is good. And that's why you get a high 1 and you're expecting more sellers above. 24, another bear bar. It closed above its midpoint, so technically a bull bar, but a bear body, consecutive bear bodies. 24 becomes the high 1 signal bar, and again, probably more sellers above the bar. We might get buyers below the bar, or there obviously were buyers during bar 24. We had this bull breakout, a deep pullback, and then maybe a second leg. 25, bull trend bar. We're triggering the buy above 24, but we know that the stop order buy was weak, and we're expecting sellers above, and that bad stop orders are good limit orders. So as good a bar as 25 looks, the bulls still need to do more. And in this context, it's still not very good. The bulls should probably more sellers above 25. And then we had an outside down bar in 26. We might be at the point, or getting near the point, where we've had 3 legs up and the expectation over the next few bars is maybe 10 bars and 2 legs sideways to down. That's the common behavior after a wedge top, or if you want to think about it as the market cycle, breakout, pullback, second leg, third leg, and then the market becomes a trading range and we test lower prices. Where is the start of the trading range? Well, for the market cycle, you have a breakout and then a pullback, and the bottom of that pullback is where the channel starts. And the channel is where the bottom of the trading range becomes. And so what's more likely? What should I use? I want to use this for expectations at this point. Are we expecting a bull breakout and a measured move up of the wedge up to here? It's not unreasonable of a place because it's where bulls got trapped. We get here, bulls take profits for a couple different reasons. Or is it more likely we come back down and test the start of the channel and the bottom of what would become a trading range? The reason it's more likely we go lower is because look at the price action when the bulls try to break out to a new high. I said it here, bar 9, breakout attempt, it failed. Bar 13, breakout attempt, it failed. And then finally another climactic third push, 21, fairly climactic bar. And then we went to a new high, but a third failure. So 3 pushes up. And what we're getting on 26 is a second reversal. We fell below bar 22, and then pulled back above 24, and then here's a second reversal falling below 25. Maybe the sell signal bar is below 25, maybe it's 26, the bear bar, but in any case, it's two reversal attempts. The bulls tried to break out, failed, tried again on 25 and got a lower high. And again, this is the same thing I was saying here. Bull breakout and then follow through. So here's a bull trend line. 23 and 24 break that trend line. We get a retest of the trend's extreme. And I say trend with air quotes because we know it's a minor trend. It's a leg in a trading range. But you get the retest and it becomes a lower high, and then you expect more to the downside. But the past 5 bars have been really sideways with lots of overlap, small bodies, big tails. The market's in a trading range. So it's a limit order market, and a lot of these bars are completely above the moving average. So there's probably buyers below and sellers above. 26 being an outside bar damages the bear case. 27, we fell below 26, breakout attempt, and failed. And what was expected, we had a tight trading range, limit order market, so traders are buying below bars, but they're scalping. And this range is really tight, so they might have bought below, and they're scalping out maybe above 27, somewhere not very far. I don't know about going all the way up here. 27 is a high 2, but again, the problem with high 1s and high 2s and trading ranges is that they're sell setups. This is not a bull trend. This is a trading range, and we're actually high in the trading range. The bulls have repeatedly failed to get breakouts, and we're probably going to have to go lower to find buyers. And that's another hint. I don't know if I mentioned that earlier. Why it's more likely we go down here than a measured move up is that the bulls are proving that they're not aggressively buying new highs. They're failing. So 27 is a high 2, but probably sellers above. 28, we rallied on the bar, tested higher, tested the close of bar 25. Bulls got trapped, maybe here, and then retested it and sold off. Now we have a third reversal attempt, maybe a low 3. Low 1, 22. Low 2, below 25. And then a low 3 below 28 if we fall below it. But again, tight trading range and consecutive dojis. So tight trading range, buyers below and sellers above. Selling above bar 28 is the better entry if we get there. 29, bull trend bar. And what's interesting about a bar like 29, it looks like a good bar and like it's a good looking bull trend bar, but the context is really not very good. And whenever you have a trend bar and whenever you have a breakout of any kind, the market is testing support and resistance. Every bull breakout is the market racing to some resistance level. Even over here, maybe this big give up bar, 44, the market's racing down. What's happening is that the market is saying, this is the wrong price, we need to go lower before we find buyers. And I won't get into it. I talked about the give up bar yesterday, but the point I'm making is that you have this big trend bar. The market price is wrong. We have to go lower. So even though it's a sell vacuum, it's testing support. And the support doesn't necessarily mean it's right here and we're going to bounce right at the close of the bar. But eventually we did find support and then bounced. In this case, it's a little different. 29 is more of a sell the close bar and a bar that I'm really not expecting to get much follow through because of what's been happening. You can always readjust your trend lines and channel lines. And so we're testing the channel line once again. And you just ask yourself, how have the bulls been doing with their breakout attempts of this channel line? Well, we know that 80% of breakout attempts fail, and breaking out of the channel line has an even lower probability than breaking below the trend line. When you have a bull channel, the higher probability event is a breakout of the trend line, which is the lower line. So 29, a bull trend bar, might look like an impressive bar, but the reality is it's a vacuum test of resistance. What's the resistance? Well, you had this breakout on 21 and 22, a pullback, disappointed bulls above, we didn't quite get to that close, the close of 22 on this retest on 25 and 26. We're testing it again. Now we have bull breakout, pullback, and then a couple legs up. The market cycle is resetting and converting into a trading range. The market's high in a trading range. And that's why I think selling the close of 29 is better than buying the close. 30, it's a bear bar and a disappointment bar. And as we know, disappointment is the hallmark of a trading range. You get a breakout bar and then disappointing follow through. It's been happening all day long. 30 is a reasonable bar to sell below for stop orders because it's a variation of 3 pushes up and it's nested 3 pushes up. You can see it in a couple of different ways. From the biggest scale, we'll start with the gap up. Here's the first push, the second push, the third push, and then we're retesting it. And then maybe here we have one leg up, a pullback, a second leg, a pullback, a third leg, and even here we rallied on 27, pulled back on 28, rallied on 28, pulled back again, and then rallied on 29. So we have consecutive buy climaxes. We're at a resistance level, the channel line, and then you can look to the left. And what happened the last time the market was at this price? It's funny. It's almost, I don't want to say simple, but it's logical. You look to the left and just ask yourself, what happened the last time the market was at this price? Well, it fell. And so do you really want to buy at a price where traders agreed that it was too expensive? Probably not. So with 30, that's why I think it's okay to sell below bar 30, and there's probably sellers above bar 30 as well. 31, a bear trend bar, good entry bar for the bears selling below. And this is the first time I'll mention always in today because it's clearly a trading range. Well, actually, I did mention it on these 2 bars, but with bar 30 and 31, probably 31, if any bull is trading always in long, and they're long for any reason, 31 is the bar they need to exit below for all the reasons I just said. And bears can sell below 31 for a swing. Maybe we get a test of the low of the day, the prior day's close, the low of the prior day. But at a minimum, the bears would like to get to the start of the bull channel and the bottom of the trading range. Inside bar 32. 32 is a low one short. And it could be better for the bears, this breakout on 31. We have a gap. At this point, we have a gap from the low of 30 to the close of 31. But that gap got tested on 32. So if a bull bought below 30, they got trapped. They had a brief chance to exit on 32. But if they didn't exit on that brief window, they're currently trapped. And this does not look good for the bulls. 3-bar micro channel, good context for expecting more to the downside. So again, probably more sellers below bars, bulls exiting longs, and bears selling for a swing. 33, we had a tick gap into the bar, and then the bar closed below the moving average. Good for the bears. 4-bar micro channel increases the odds we get a second leg down, and sellers above. 34, continuing lower, buyers into the close, but not a good buy signal bar, a 5-bar micro channel, probably sellers above 34. Completely below the moving average, and that is only the second time, maybe actually the third time, the bears had a bar completely below the moving average all day. And so that's unusual, and it's a different, I guess you would say, event. So probably sellers above 34 and going at least a little bit lower. Around this area, bulls will argue the bar 21 breakout. There's buyers below, and there will be buyers below 21. So at a minimum, we should bounce below bar 21. And then 35, another interesting bar, because if a bull did buy below 21, we talked about this earlier. If you're buying with a limit order, it's like catching a falling knife. When you're buying with a limit order against a micro channel, not ideal. And then this is your entry bar, 35. If you're a bull and you bought, how do you feel with your entry bar? If you bought the low of the bar, maybe one tick below, you're at a small profit, but the bar is basically a bear bar, and in a micro channel, it's not what you wanted. You were hoping for a bar like 24 yesterday, where sellers get trapped below and it reverses up in a big way. But instead, we did have some buying into the close, but it's minor. And the reality is this is all one leg down, so probably sellers above. And because of this entry bar for the limit order bulls, those sellers might just sell the close. The bulls might be that disappointed. 36, we actually did bounce. And what happened is bulls bought, they scalped on 36, and they tested a breakout point to the left, which was the 24 low. This micro channel went straight through the 24 low. There were buyers there. We get to the 21 low, bulls come in again, and then we test it and reverse down. So not looking good for the bulls at this moment. Still a micro channel down to 36. 36 is an inside bar. We might start to go more sideways with buyers below, but enough momentum. This should get a second leg, and that second leg could carry us down to this red line, the start of the trading range. And 37, a little bit of a surprise, but everybody was in agreement that was going to happen, so everybody sold the close of 36, and we raced straight down to that price, and that's where bar 37 is stalling. It's still a micro channel, and it's enough momentum that they should get a second leg, but 37 is getting a little bit climactic, and it's in a support area. We are expecting buyers in this area. We had buyers earlier, but the difference in this area, let me see if I can find an example with yesterday. It's like I said earlier, actually. Here's a sell-off, and then the market comes back to test it and sells off again. Over here, here's a rally, but the rally is fairly weak. It's mostly a trading range, whereas this was more of a trend. And so when we retest this one, we're expecting more of a trend down, whereas here, maybe we go sideways, but this was not very impressive by the bulls. We may have to go lower before the bulls come in. But in general, just looking at this day, it's a trading range day. So not really ideal to be selling low in a trading range. I did say there's enough momentum to the downside that the market will probably go lower. But you have to be quick to manage your trade, especially when you're short entering a buy zone. Because 37 is a climactic bar, the reason you get 1 to 3 bars sideways after climaxes, especially in trading ranges, is because you have bears taking profits. Some bear sold all the way up here, maybe below 31 or 32, and they're swinging. And then you get this windfall of profits right to the bottom of the trading range. So that's enough reason for traders to take profits. And I say it's enough reason for traders to take profits, but again, it's still this tight channel and a micro channel. There's not enough reason to buy, at least not yet. And that's why 38 reversed. We had a bull bar. We went below 37, and then 38 is a bull bar closing on its high. Even though it's a bull bar closing on its high, it's probably a minor reversal. But bears, they might take profits above 38 and wait and see what happens. And as far as buying above 38, I would not, because it's more likely minor. This is too much down to the downside. And the odds are the first reversal. We haven't had a pullback in all of this, so the first pullback is more likely to have sellers above. And so that's what happened on 39. But then you can see what happened on 39 when we went below 38. Bears, maybe they sell again above 38, and then 39 goes to a new low below here and below the low of the day over here, and they take profits. So the bears have their minimum. Here's leg 1, and then a pullback, leg 2. So what about buying above 39? It's 2 legs down in a trading range. Well, the context is okay because you're low in a trading range, but because of the most recent price action, it's hard to want to buy after this tight of a channel. It's really better if the bulls can break the trend line first and get more buying pressure. But the bulls did get a decent bull bar, 38, and that's a start. But 39, there's probably sellers above. It's not a good buy signal bar. and probably buyers below taking profits. That's what happened on 40, testing lower, bears taking profits, testing near yesterday's low. That's the blue line. We may have to get there, but 40 is a pretty dramatic bar. It fell a pretty big distance, but rallied all the way back up. Not a great buy signal bar. It's a trading range bar on 40, but it is now 2 legs down at the bottom of a trading range. Leg 1, pull back, leg 2, and then the last time we were at this price, we rallied for several legs. So the market's overall in a trading range. We're low in the range, and so not ideal to be holding on to a short after you see this much buying. We triggered the buy above 40, which we're expecting sellers above. It's a trading range bar in a tight channel. So bear bar 41, but 41 is an example of a low one short, low in a trading range. And as strong a bar as it is, context always trumps the price action or the candles. So you think about the context and you just glance at this chart and you ask yourself, is the market in a bear trend or a bull trend? And the answer is neither. It's sideways. And you ask yourself, okay, it's a trading range. Where are we in the range? Are we high? Are we low? Are we in the middle? Well, maybe this is the range. You can even just use today's range and maybe with the low of yesterday. And it's clear the market's low in the range. This is the lower third. Here's the middle third. Here's the upper third. So best to sell in the upper third and buy in the lower third. Take profits somewhere in the middle. So the problem with the low one on bar 41 is the context. We're low in a trading range. And now the bears, it's a little tricky to see this. It's a parabolic wedge. We sold off down to 35, pulled back. Not a technical pullback on this chart, but on a lower time frame, you could probably go to the 4-minute and there's a technical pullback. So we rallied, and that's a pause. So sell climax, pause, sell climax, pause, another sell climax. So the market is getting consecutive sell climaxes to the bottom of the trading range. It's really dangerous to be short or shorting when the market's doing that. What the market's doing is searching for support. And when it's sell climaxes like this, and it's kind of choppy, like it's going down, and then it pauses, and then falls a good distance, pulls back, falls a good distance again. It's not ideal trend behavior, even though it's a tight channel. I don't know if I have a good example. The point that I want to make here, why this isn't ideal for the bears, why can't you sell this low one? It's a tight bear channel, so only look to sell, right? So it always goes back to context. And you look to the left, and the reality is the market's in a trading range. And we're low in the range. And even the price action leading up to this low one, there's problems with it. I mentioned earlier, sell climax, pause, sell climax, pause, another sell climax. The sell climaxes are a problem. The ideal, this is not what the bears want. A good bear trend, I actually pulled one up. It looks like this. Small pullback bear trends. They don't have any extreme climactic behavior. You can see here at the channel line, there's no breakouts far below the channel line and deep pullbacks. All the bars are below the moving average, and the moving average is parallel to the price, and that's different from what we got today. Here's the moving average, and the price is getting away further from it at a faster rate, and that's parabolic, and it's not sustainable behavior. So that's the problem with the low one at 41, and why there's probably more buyers below. 42, a bull reversal bar. So it might be a bear trap below 41, and then a bull bar closing on its high 42. It's good for the bulls, but it's more of a bar for bears to exit shorts than for the bulls to buy, because the reality is it's still a tight bear channel, and the bulls have to do more. Not enough buying pressure. The bulls do have good bars, 38 and 42, but no trendline break yet. What the bulls do have going for them, and there is a reason they can be aggressive, is because it is a trading range. And it's not uncommon to see tight channels reverse without getting a retest. But buying above 42 is certainly aggressive. 43 we did not trigger. We're going a little lower on 43, but again, we're testing support, and it's not ideal. This is not strong behavior by the bears. These are sell climaxes to the bottom of a trading range. Probably more sellers above 43. It's not a good stop order signal bar, but there's probably buyers below 43. And then 44 becomes a problem for the bears. It's technically, you can say it's a second reversal. Bar 40 triggered the buy, we pulled back. Now we have a double bottom here and with over here. Strong signal bar. 44, the bulls keep getting bars closing on their high. It's good buying pressure, and it's good context. And if a bear sold above 43, and this is their entry bar, I mentioned that a couple times earlier in the video, this is a bar where bears who sold above, looking for more to the downside, they might just exit on the close of 44, disappointed, and they'll look to sell higher because they know they took a chance selling low in a trading range, and that's what they're doing. So 44 is a bull bar closing on its high. It's a big bar, and it's a second reversal. Always in traders, bulls will buy above 44, and bears need to exit above it no matter where they sold. If you sold the low tick of 43 and you get bar 44, you have to exit. You don't scale in on a bar like 44. There's too much of a risk that we're at the bottom of a trading range. This is a leg one, and we're going to rally for several legs, maybe come back and test the top of the trading range. It is a trading range day. You look at this and you know it's not a bear trend day. So if you're selling here, your premise is that it's a bear trend, the low one. The only way you can sell low at the bottom of the day's range is if your premise is that it's a bear trend day, and it's just not a bear trend day. Just look to the left. So 44 is a problem for the bears. 45, the bulls get follow through. So consecutive bull bars, both closing on their high, one of them being big. But for the average bar range, as of the last maybe 5 to 10 bars, these bars aren't especially big. We may have to pull back, test a breakout point, 43, before the buyers come in. But big enough surprise that it should get a second leg. Even though it didn't cross the moving average, it did move a big distance. And the context is good. The bars are fairly uniform in size with very little overlap. That's good for the bulls. 46 pulling back a little, maybe 30% of the breakout. The bears hoping to get back to the breakout points. 42 high, 43 high. 46 not quite getting there, so there's still a gap from the high of 43 to the low of 46. I'll draw that again. Because gaps are a sign of strength. The bulls create a gap on the line chart. And if they can keep that open, that would mean bears got trapped, scaled in higher, never got a chance to exit at break even, and they'll be forced to exit with a loss, which will provide fuel for the subsequent legs to the upside. 46 is not a strong sell signal bar, and it's after 2 big bull bars, and it's low in a trading range, so not many traders will sell below 46, probably buyers below. It's a high one with a bear bar, and it's not an ideal place below the moving average, so there might be sellers above, any more complex, maybe 2-legged pullback before we continue higher. So we triggered the buy above 46 and found sellers above. Micro double top 45 and 47. Sell signal bar 47 has a bull close, and the context is bad. There's probably buyers below. As always, I apologize for any background noise. 48, bull surprise. We're getting the bull breakout, crossing the moving average. It's a shaved bull bar, and that's good for the bulls. It's also technically a micro channel. It's all one leg from 43 all the way to 48. Increases the chances we're going higher, and there's buyers below the first pullback. 48 strong enough that it should go higher, and any pullback like to the 47 high, testing breakout points, should have support. And we're going higher in this trading range. Magnets and targets for the bulls include maybe buying below 29, the bull bar. We are testing a magnet here on 48. Remember when bulls bought below 21 in here? If they weren't quick enough to scalp, they got trapped. They scale in lower to the bottom of the range. They get back here, they might look to exit. But so far, 48 just plowed straight through that resistance. So we're probably going higher. 49 pulling back, bear bar, and you can argue maybe it's 2 legs up to 45, and then a pause, and then a second leg. But it's a minor 2 legs, and it's more clear maybe if you look at a 15-minute chart that it's really just 2 bull bars. Every bar that has a number on it, there's a reason I like to have every 3 bars have the number, and it's because it correlates to the 15-minute chart. So it's a pretty easy way to visualize what the 15-minute chart looks like without having to look. And so up to 45, we had a bull reversal bar who fell on 43 and then reversed, closed near its high. And then up to 48, that's it. So that's these 3 bars, 43 to 45, is one 15-minute chart. So it closes on 45, it opens on 46, here's the next bar, small tail below, and then 48 rallies, closes on its high. You can see them right here. So 49, it's minor, and even if we fall below it, there's probably buyers below. Still a micro channel, so for that reason as well. And we got a pullback on 50, but minor, and it's a trading range bar. It's an outside bar, so you can argue sellers above, buyers below. But in this context, I would only buy below because there's enough momentum, and this is enough of a surprise in a leg 1 that we should find a second leg after the pullback, and we just got the pullback on 50. Keep in mind the gap is still open, 43 high, 46 low. So bears did not get a chance to exit here. 48 is a give up bar. Now we have an open gap with the 46 open, the 49 close. So another gap. If the bulls can keep that open, it's even stronger. And then 51, another give up bar. So now you can argue 3 pushes up, a little bit of a parabolic wedge, 1, 2, 3. But parabolic wedges are minor. They have minor reversals. So even though it's not ideal to buy 51 because it's 3 legs up, some algorithms see it that way. The reality is, like I said, on the 15-minute chart, go to a higher time frame chart, and it's all just one breakout. And it's the first leg at the bottom of a trading range. So would not sell 51. And it's always in long, and you can be long expecting a test of higher prices. 52, we have continuation, and it's a little bit of a surprise. We had a tick gap from the close of 51 to the open of 52, and after 3 pushes like this, even though they're minor, you're expecting a little bit of a pullback, but instead we rallied on 52. We're testing resistance, the bar 29 low. The next target, maybe if a bull bought below bar 30, or maybe they bought the close of bar 29. So this might be a magnet. But the point is, over here was resistance. So when we get back here, we're expecting bulls to take profits and bears to start shorting. Outside bar 53, similar to 50. So probably buyers below, but I would not sell above it. The momentum is too strong. This is probably all one leg, and any pullback is minor and will probably lead to a second leg up. Inside bar 54, so IOI. But there's probably more room to the upside. So if you're selling here, the market's probably going higher, and that will reduce the number of bears selling directly above bar 54. And bulls will buy below, betting it's a rally, and any pullback should lead to higher prices. So buyers below on 55, it becomes a high 1, maybe a high 2. It's a double bottom with 53 and 55. But it's a trading range. The past 3 or 4 bars all overlapping and small. So there's some resistance above and support below. But overall, the context, do you really want to sell? Probably not, especially when there's more room to the upside. 56, a bull bar, closing on its high, probably going a little higher. Minor pullback here. It's still really tight. No major trendline break, so bulls are still buying and scaling in on pullbacks. And then 57, a little bit climactic, rallying, testing the 60-minute EMA, testing the high of the day. Here's the high of the day. We get a perfect test. It's a logical place for bulls to take profits. But as far as selling 57, not ideal because the momentum is strong. We've had, since bar 44, how many bear bars have we had? Really just one. I think 46 closed above its midpoint, and we've had a couple dojis, but the selling pressure is just non-existent. So not ideal, probably buyers below 57, even though we're at the top of the range. This wasn't very climactic. The bulls fairly orderly, and lots of good bull bars along the way. 44, 45, 48, 51, 56. Probably buyers below 57, but they're buying for a scalp. The upside might be limited because it's similar to this, where now you're low in a range. Now it's a good rally, but high in a trading range. 58. Tested the low of 57 and then reversed up. Bull bar closing on its high. Might go a little higher. But there's still nothing to sell. The bears are looking maybe for a sell setup, but they're not getting one yet. So the bulls can hold on. The bears stepping aside, waiting for maybe a trend line break and some selling pressure. Again, this is the one bear bar in all of this rally. Another bull bar, but it's a doji overlapping the past two bars. It's a trading range bar. There might be sellers above, and we're at the top of this trading range. And then surprise bar 60. Bull breakout, breaking out above a lot of bars to the left. You look to the left, this bar closed up here, closing above all of these bars. It's a fairly major breakout. And it's a good breakout bar. Closing above the 60-minute moving average as well, new high of the day. The bulls still need follow-through, but it's a strong rally and then a strong bar. What about it being an exhaustion gap? Well, it is either an exhaustion gap or a measuring gap. And you can argue it's more likely an exhaustion gap because of the context or in a trading range. But we have open gaps. My concern is the open gaps by the bulls. We've had several. So I'll highlight that here. Bears selling above bars, limit order bears, not making money. That's a big problem. So 60, it's another give up bar from the bears. But again, the bears, it's hard to sell the close of 60 or even on the follow through bar if it's bad on 61 because 60 broke out above many bars. And it's like I mentioned earlier, the top of the trading range could be all the way up here. So if the top of the trading range is up here, maybe bulls got trapped at this breakout point. You can see there's still room to the upside. And then we got 61, a really bad follow through bar, really not follow through. So that increases the chances. 60 was an exhaustion gap, and the minimum target is the high of bar 59 to close that breakout point. We did close the breakout point of 57, but what about selling below 61? It's not ideal, even though you might be high in a trading range. It's also interesting. It's obeying the channel line from earlier. 61 is a strong bar, but hard to sell it after this much of a rally. And open gaps. So probably buyers below, and the bulls will likely get a second leg to test the bar 60 close. So bears, they get a breakout on 61. The reality is inside bars, actually it might have gone above. The high is 36 and a quarter. The high is 36 and a quarter. So it is an inside bar. Inside bars are the only non-breakout bars. So 61 is really not a breakout bar. And that troubled me for a while because if an inside bar is a trend bar, and Al says every trend bar is a breakout bar, how can that be? Well, technically 61 is breaking out from the close of 60. But it is inside the range of 60, so it's more minor, more likely a pullback and buyers below. That's what happened on 62. But bear breakout bar, it's a trend bar, and then you get 62. Do you want to buy above 62? Probably not. Not ideal. 63, another bull bar. 62 is a doji, but had a bull body, and then 63, another close for the bulls. Good for the bulls, probably buyers below 63. This was enough by the bears to get a second leg, but it's probably minor because of the context. 64, big bear bar. A little bit of a surprise. 2 legs down, leg 1, pullback, leg 2. Crossed the moving average, but could not close below it. But we're testing breakout points where here was an IOI, or not an IOI, but tight trading range breakout mode. You had bears selling above 55 betting this was maybe a final flag high in the range. Instead, we got the bull breakout. So we're testing that area, probably support in this area. And we tested a little lower as well near this breakout point. And then an inside bar on 65, probably buyers below. Might have been a strong enough bar for a second leg, but that second leg is also likely to be minor, especially considering the context. And 66 was the absolute bare minimum second leg, including 65. So what happened, you can see this on a lower time frame. I won't show it, but I'll explain it briefly. 64 sold off, but it's already a second leg in a bull trend. So 64 sells off, pulls back all the way up to the high of 65, and then 65 sells off, 66 sells off, tests the close of 64. So the high of 65 to the low of 66 is that second leg for the bears. It's hard to see it on this chart because it's in the tails, but if you break it down, maybe look at the 1 minute chart, you'll see it. 66 reversing up, probably buyers, bears buying above 66. It's probably going higher. We're probably going to test maybe the 60 close somewhere up here. 67, disappointing bar for the bulls. Instead of buying the close of 66, bulls buy a pullback, maybe a 50% pullback of bar 66. We bounced around the midpoint of the bar. And then 68 going a little higher, but sellers above bars. But do you really want to sell below 68? Probably not. Probably buyers below going higher. 69 broke out below and then reversed up. You can call it a high one, but really in the middle of the range, and big enough surprise by the bears here, a couple big legs down, that the market's back into breakout mode. Unfortunately, I have to speed it up a bit here, but the market's in breakout mode. And I mentioned triangles earlier, and I think it was maybe here, bars 3 and 4, it was a triangle, the inside bar. Whenever you get breakouts of triangles, 50% chance the first breakout is the wrong direction, and then the market reverses. And that's what happened on the open of the day on bars 5 and 6, the bear breakout, and then it reversed. Every triangle is a trading range, and trading ranges they represent balance in the market, the bulls and bears trading on market control, and they're scalping. And the apex of the triangle is the magnet for the breakout. So you can see we broke out and then we immediately tested back, broke out again, tested back to it, even over here, testing this area. So I suspect any breakout of this triangle, up or down, will likely come back to the apex of the triangle before long. And I'm a little biased after this rally, two-legged pullback, probably go a little higher, but the upside's limited. But I do think the bar 60 close will get tested, if not today, probably tomorrow or later in the week. Bull breakout 70. Also, why do I suspect the bull breakout? I mentioned this big rally. We'll probably get a second leg. And then look in here. How many bear bars do we have? You can argue 68, close below its midpoint, 65, but both had bull bodies, and they're really just trading range bars. So we're getting the bull breakout, still need follow through, 70, but in a bad area. Even if you get follow through, there's resistance at the bar 60 close. Follow through 71, consecutive bull bars, but bad context, 2 legs up, high in a trading range, more of a sell to close bar, but kind of tight and aggressive. 72, bull breakout. We're getting a breakout above the swing point here, but 72 is the only bar closing up here. So bull breakout, but still need follow through. There's the added risk that it's leg 1, pullback, leg 2. We're getting late in the day, and this was enough down that this could all be a trading range. 73, no follow through for the bulls. Instead, they sold the close of 72 and we're falling back down. Remember what I said about the apex of the triangle? Probably the target's probably in this area. 74, another bear bar. Minimum follow through and a bad buy setup, so probably more sellers above the bar and on the close. If a bull bought below 72, 73, that's a disappointing entry bar. And that's what happened on 75. They gave up. The market raced down to the apex of the triangle. So we rallied, sold off, big up, big down. Market's in a trading range. Three bear bars to the downside, testing the moving average. Probably going to go more sideways. Inside bar 76, probably buyers below, apex of the triangle. And then buyers below on 77. The market's likely to go sideways into the close, and it's more sideways. It's a trading range at this point. So buy low, sell high, and scalp. Bull reversal bar, but micro channel down. There might be sellers somewhere up here. And then 78 rallied, but sold off. There were sellers above. They didn't come in until a new high of the day. But what was the new high of the day? 3 pushes up. And look at that. It's on this channel line as well. Very interesting. Did not mean to do that. What do you do on 78? It closed in the middle of the trading range. Not ideal to do anything here, especially with 2 or 3 bars left in the day. Better to just wait, and in this context, more likely to go sideways. 79 a bear bar, but there's probably buyers below 78. This is low in the range, 2 legs down, buyers below. And then an inside bar, it's a bull bar. Consecutive inside bars, breakout mode, middle of a trading range. Not ideal to be initiating trades in either direction. And then another inside bar, 81, to wrap up the day. For always in is always tough on trading range days, especially in here. I didn't mention it until here when we had consecutive bull bars, but the context was bad. So this can trick you into thinking it's always in long, consecutive bull bars, one being big, closing on its high. But you look to the left at the context and you see every time the market has gone to this area, you look to the left, I had that channel line drawn. There's resistance. So always be careful when you think it's always in long, but the context seems to be a trading range. Over here, became a little different. Here's how always in is with trading ranges. It's sort of like hidden, because by the time it looks clearly always in long, it's too late, like bar 22. And then I mentioned over here, always in short below 31 because of the context. So it doesn't look all that bearish, and it's still a low probability trade, but you have had multiple attempts to break out by the bulls. It's more likely a trading range. Open gap below, we're probably going to get a test of it. That's why it's always in short with context here. Then it starts to look more and more bearish. 37, a big bear bar, micro channel, but it's a sell climax to the bottom of a trading range. So it might trick you into selling. Then you get a pullback immediately after. Over here, I thought this 44, or definitely by 45, but 44 similar to over here, where you have a buy set up at the bottom of a trading range and a good signal bar. If it wasn't always in long on 44, 45 may have convinced traders, even though it's below the moving average, because it's a trading range. And if it was always in long, no reason to exit until bar 61. When it's always in long, you can exit below a bear bar, closing below its midpoint. Does that apply to bar 49? I don't know. You can exit below 49, but if you do, you have to buy again above 51, a bull bar closing above its midpoint. But 50 or 49 was more minor, and 61, obviously a bigger bar, worse context at the top of the range after a climactic bull bar and late in the trend, already maybe 20 bars into the trend, whereas here was only about 5-6 bars. And for the rest of the day, this is a place where it might trick you with always in long, but looked at the context, it's all overall sideways. So probably always in short on the close of 72. 72 is one of those bars I mentioned. Well, I might not have said it directly, but the bulls needed one more bar. And when the bulls need one more bar, the bears will sell the close, betting they won't get it. And then for stop orders today, I mentioned a couple. I thought you could maybe sell below 15, taking a chance, but really not ideal with the tight trading range. Maybe get a test of bar 6 high, and that's what we got on 18. 18, I thought you could buy above because trading range might be low in the range after testing a breakout point. but really not an ideal bar to buy above because still tight trading range, and it's a trading range bar. And then up here, I thought you could sell below 31, 32, 33. And then probably buyers above 44, buyers above 48, buyers above 51, buyers above 56. But getting close to the top of the range, they might be scalping on 57. And then maybe aggressive bears sell below 61, betting we had an exhaustive buy climax, high in a trading range, and we test the moving average. Buyers above 66, 2 legs down in a bull leg, fairly strong, expecting a second leg. This all could have been one leg. And that would probably do it for stop orders today. For limit orders today, I thought there were sellers above bar 2, buyers below bar 2, but they may not come in until I had bar 80, the high of bar 80 marked, and that's where bar 6 tested. Sellers above bar 1, they came in a little later, and then all in here, it's a tight trading range. Sellers above bars, buyers below. And then bad high 124, sellers above, high 227, but high in a trading range, or a bull channel, sellers above that as well. And then this bear channel, the first pullback, likely to have sellers above, that came on 39, triggered on 39. And then 40 was a bad stop order trade, good limit order trade, but it's a scalp because you're selling low in a trading range. And then micro channel, buyers below the first pullback, 50 and 49, triggered on 50. And then same with here, still not a micro channel technically, but tight bull channel, not enough selling pressure, buyers below bars, and that triggered on 53, buyers below here as well. Betting it's a minor reversal and that the bull trend continues. And then weak buy setup, or signal bar, 62, after a big bear bar, high in a trading range, sellers above that high 1. Weak low 1 on 68, and support below the moving average, 2 legs down in a bull trend. So buyers below 68. And then the inside bar, after a big up, big down, there were probably buyers below 76. And then sellers above the high of the day, which triggered on 78. And then really tight in here. And then where do we go tomorrow? The market's rallying. We have open gaps, breakout points, not closing. That's good for the bulls. Now we've had 3 consecutive bear bars, but tails below. If you look at a lower time frame, you'll see maybe 3 legs down and a wedge bull flag, and then a decent buy signal bar here today. So you might have bears exiting, looking to sell higher, and that may cause a rally. And some bulls will buy, betting, but it's a tight bull channel and then a wedge bull flag with a good signal bar. But I do think the upside is limited because we had an outside bar on Monday, which is a trading range. The market might be converting into a trading range. So if we do go above and trigger the buy, it might be a trap. It might be a high 2, but high in a trading range. I do think this leg from the bulls will eventually be a leg in a trading range. We just haven't seen the bear leg yet. We have the moving average, which is a magnet below. Please feel free to leave questions in the comments for me. And if you have a question specific to this video, just leave a timestamp and I'll get back to you as soon as I can. And with that, I hope everybody has a good rest of their night. Thanks for watching.